firm you're working at is going to calculate sample size for you, right? You put in your parameters, but you got to put parameters in right, okay? It'll give you the sample size. And it's going to calculate the result for you, right? What it means, the significance of your results. You've got to be able to interpret that though. You got to know what you're looking at, okay? But that's far better than just kind of, oh, well, that's about right. You know, I kind of like to say at a 95% confidence level, I think the number is between here and here. Or at a 90% confidence level, I think it's between here and here. Instead of saying, oh, I think it's about right. Okay? So, yeah, do I believe in statistics? You bet. Do I think it replaces judgment? Of course not. Right? Okay? So kind of get a view on that. The other thing is, I think a lot of the people who are taking the auditing section of the CPA exam are not going to have a clue about statistics, and hopefully you will a little bit by cranking through this stuff a little bit, looking at it a little bit. Okay? So anyway, that's what's going on here. Somebody made the comment, there are a ton of terms in here. Oh my gosh. Just unbelievable. Take a look at, let's just sort of flip through the chapter. I know it's long, but you need to know what these things are. What is sampling?
The selection and evaluation of less than 100% of the population of the audit relevant, such as the auditor expects the items selected to represent the population and thus likely provide a reasonable basis for the conclusion of that population.
How about that? Yeah. Sample, you should look at less than the population. You get less than all of them. So if there were 1,000 customers, if I look at one, that's a sample of one. If I looked at 999 out of the 1,000, that's a sample of 999, and you could be anywhere in between those. Got it? It's a sample. It's a subset of the whole. If I look at all 1,000 accounts, guess what? It's not a sample, it's the population. Got it? If there's 1 million invoices and I look at 30 of them, that's a sample. If I look at 100, that's a sample. Got the idea? That's it, okay? So, that's on page 476 at the top. Absolutely. Okay, what's a representative sample? There it is. One where the characteristics in the audit sample of the audit interest are approximately the same as those of the population. What does this mean? I want a sample that looks like the population. What do I mean by the population? All the checks the company wrote during the year is the population of checks they wrote during the year. All the approvals of purchase invoices, purchase orders, all the approvals on the purchase order. Every single one of them. Add them all up. None are missing, right? And there aren't any in there that weren't done this year. That's it. That's a population, okay? When we're testing controls or testing details of transactions, which is what this is about, those would be the populations. They're usually huge, right? They're really big. So we don't have to worry about population size when we're doing our sample size, right? When we get into the substantive testing of the ending balances in chapter 17, now population size matters. Why does population size matter? Because you might have a population of 200. You have 200 customers. Do you really want to select a sample that's 150? No, you don't need to. There's only 200 of them. Got the idea? What if there are 10,000 customers? You might have a sample size that big, depending on what? Risk. How much risk of what? Risk of incorrect acceptance you're willing to live with, right? That's it. Incorrect acceptance is the number. When you're always going to have risk. That's how much you're willing to have. Okay? So, if you want risk to be low, guess what? Your sample sizes are going to be high. If you're willing to accept higher risk, what's going to happen to your sample size? They'll be smaller. But guess what? The audit's cheaper, but you have more risk. Risk of what? Audit failure, right? What does that mean? You give an unqualified opinion when the numbers are wrong, right? Take the risk of that. That's what's going on when they talk about risk. Okay, so anyway, it's approximately the same as those of the population. You want to be really, really careful in how we select our sample size, right? I'm looking at 25 out of 100,000 invoices. Do I want to be real careful that every single one of those 100,000 has an equal probability of being selected? Yes. Otherwise, I have no hope of getting one that's representative. Well, very little hope. Okay? That's all. So you can be really careful how you do this. That's all. All of this is common sense. But okay. Sampling risk. Next on page 476. What's a sampling risk? It's the risk that the sample will not be what? Representative. of the population. I didn't get a sample that looked like the population. Imagine if you're only looking at 25 out of 100,000. You need to be pretty careful to make sure you get something, each one of those represents a portion of the population. Yeah, okay. So it's a risk that you could have an incorrect conclusion. You rely on the internal controls, right? Test the controls. You believe that the transactions are being recorded correctly. Tested the transactions. You believe the ending balance is correct, even more significant. By the way, does that make sense that that's a bigger risk? You're more concerned about that risk? The risk that the balance is incorrect versus the risk the controls are weak? Which one do you worry about more when you're giving an opinion on financial statements? That the ending balances are wrong is what you're really worried about, right? Why do you worry about the controls? Because you can reduce your substantive errors, right? Why else do we worry about controls? Because we're going to give an opinion on controls too, right? They need to fix the controls if they're weak. You guys all seem so excited about this. We've only beat it to death over and over, right? So that's sort of the idea of this class. Okay, anyway. So that's the risk that the sample screws you up. But even if the sample is good, can you screw up some other way? Yes. What's non-sampling risk? I might pull a really good sample. I look at the documentation. I'm looking for 2 check signers on every check over $10,000, say, right? And I scanned through them, and there was one that only had 1, and I thought it had 2. I miss it. Non-sampling risk is the risk that you'll make a mistake. Something else will happen, right? Other than your sample being bad. That's all that is, okay? So you reach an incorrect conclusion for any reason not related to sampling risk. It could be all kinds of things. All right? Okay. The sampling risk meter, huh? That's funny. All right. So what's the deal here? How am I going to adjust my sample size? If I want less risk, I increase. If I'm willing to accept more risk, I can decrease. Okay? So, yeah, adjust sample size and use the appropriate sample selection method. So we'll talk about those. All right. Anyway, statistical versus non-statistical, they're exactly the same thing. Only one has statistical validity, the other doesn't. We plan the sample, we select the sample, perform the test. You guys made that comment earlier. Evaluate the results, exactly the same. What's the big difference? We can quantify how much risk we're taking in statistical sampling. In non-statistical, the auditor looks at those we believe will provide the most useful information. There are instances where I use judgmental. I do like the term judgmental better than non-statistical personally. It's non-statistical. Let's say I have 1,000 customers, but 4 of them represent 90% of my accounts receivable. I think I'm going to apply my judgment, and I am going to stratify my sample. I am going to confirm all 4 that make up the 90%. That doesn't mean I'm going to ignore the other 10%, because guess what? If somebody wanted to misstate the financial statements on purpose and get it by me, would they know that I'm smart enough to look at the 4 that make up 90% of the receivables? Of course, they know I'm going to confirm those because I'm using my judgment, right? But I'll still take a representative sample of the other 10%. Probably a pretty small sample because it's only 10%, right? But I'm going to do it because that's where they commit the fraud if they were going to do a fraud. Also, even just mistakes. You think people might be more careful on the 4 huge customers than on the other, if there's 1,000 customers, 996 that make up the other 10%? Got the idea? Right? So they might even be more careful. They might have better control over those 4, believe it or not, right? So I'm certainly going to stratify my sample. Well, that's judgment, right? But I'm still going to use statistics on the rest. Does that make any sense? I'll still do both. So they imply you can't use them at the same time. Of course you can. Okay? And by the way, have I violated statistics? Do I have a true random sample if I take 4 big customers and then take a random sample from the other 996? I violated statistics. So what? I'm still going to do it. That makes sense? Okay, so you look at the major stuff. It's just no big deal. All right, and make sure you pick up appropriate things. But be careful with non-statistical approaches. All right, probabilistic versus non-probabilistic. Sample selection is a method of selecting a sample such that each population has a known probability of being included. Non-probabilistic, you tend to use professional judgment. You need to be careful with non-probabilistic, okay? And here's some non-probabilistic that I would never, ever, ever use, okay? And the reason is I don't need to, one, and two, it diminishes the quality of my samples, or potentially does. What's block? We used to do quite a bit of this because it was real convenient. What would block be? I want to test internal control over approval of credit. I pick 1 month, and then I take a sample from within that month, right? And I look at the proper approval of credit on those in the sample. That's block. I took a block. Or maybe I just take 1 day, and I check for approval, proper approvals on that day. What's the problem with that? Why is this not allowed? They're running the business 365 days a year, and you look at 1 day or 1 month. Why would you possibly do that? To save time. It's easier to pull the sample, easier to get the work done. You can do it at an interim date. Is it more of a pain to spread it out throughout the year? Yes. What do? What's the answer on the CPA exam? You spread it out through the year. You don't use block. Okay? We want to make sure we get something for, well, we can't make sure of that, but we want every approval in this case, right, for the entire year to have an equal probability of being selected. We really prefer that. Haphazard, same thing. I just arbitrarily choose them. You know, all the customers are listed on a sheet of paper, and I just take that one, that one, that one, that one, that one, that one, that one. What do you think? Or all the checks that were written during the year. And I just open up the check register and I take some. Might it be random? Sure. Do we know it's random? No. By the way, you will for sure miss the ones that aren't listed here that exist. Oh, now look at a sheet of paper. What's listed there? What if they leave off the ones they don't want me to look at? Versus if I use a random number generator, right? The number's going to come up. All the voided ones will come up, right? Okay, so we wouldn't use that. Haphazard, we wouldn't use. Okay. Probabilistic, simple random sample selection. On page 479, it shows a random number generator for Hillsburg Hardware. They came up with a bunch of numbers and then they sorted them in ascending order. So what you do is you say, what are these? These are, tell us what they are. Oh, well, maybe they're check numbers or something, okay? Anyway, or invoice numbers or something. You put in the beginning number and the ending number that you used for the year, and the random number generator will select whatever quantity you want, right? It'll select all the numbers that you should look at. You haven't decided on any of them. Might you select some that are voided? Sure. Might you select some with errors? Sure. Might you select some that are right? Sure. Right? So you're not biased at all in your sample selection. You just go whatever it gave you. Okay? So this is a truly impartial way of getting your sample. That's all. Okay? So simple random sample selection. A systematic sample. You need to be careful with this one, right? But it's still okay. So let's say that they're not computerized. Okay? They got a file cabinet full of invoices. And a little tiny client, right? They got a file cabinet full of invoices. And there's a lot of invoices still. There are thousands of them in there. But they're in a file cabinet, right? In order. What could you do? You could select a random starting point. You count back X number, right, of invoices. I'm not kidding, right? You could do that. And then you select an interval that you want. So the first one is, I'm using a random number generator. Maybe I pick a number, right? Okay, or just arbitrary. I count back 120, right? And I'll take that. And then I compute an interval. I estimate how many are in the file drawers in total, right? So how many thousand there are. I take my sample size, divide into that, and I've got an interval that I'm going to count. So I go back 120, and maybe my interval is 250. I count through 250 invoices, and I take that one. I count through 250 again, and I take that one. 250 again, and take that one. And by the time I get done, I've taken some throughout the file cabinet. Got the idea? Is this really random? Maybe. What's the risk? Bias in where I started? bias in the interval, although there's probably not bias. I mean, you know, especially if I use a random number generator for the first one. But what could happen? What if my interval is 200 and I have exactly 200 customers? I get the same one over and over and over and over. Maybe an easier way to think about it is, let's say we did it on payroll. I have 200 employees, and I pick every 100th one. What's going to happen? I'm going to hit the same employee over and over and over and over. Get them over and over and over. Am I going to get a representative sample? No. So what do you have to know? You have to know that when you use this systematic sample selection, they're not in any particular order, right? The documents are not in any order. The records aren't in any order. Got the idea? So I'm not inadvertently getting the same one over and over and over, okay? And of course you can check your sample after you do it. By the way, even with simple random sample, might you get the same one over and over? Sure, there's some probability you do that. It can happen. It's okay, right? Then we have to decide if we're going to do with or without replacement. What's better statistics? To pick a new one or to keep the duplication? Let's say I'm doing customers. This is an easy one. I'm picking from 1,000 customers. What if I get the same customer twice? Am I going to send them 2 confirmations? Of course not. What would statistics say you should do? You should send them 2 confirmations. Right? Classical statistics would say what? If you select one twice, you do it twice. What do we, of course, do in real life? We use our judgment to say that's stupid. The customer would think you were crazy if you sent them 2 confirmations, right? So we don't. What do we do instead? Select another one. Violated classical statistics, just terrible. So I'm not saying you follow classical statistical models necessarily, right? But follow them with judgment added. Okay? So there's another example, just like the stratification thing. Probability proportional to size, when we get to doing things like accounts receivable, anything where you're doing an ending balance and you want to make sure that you get the big accounts. The example I gave you where we had 1,000 customers and 4 are real big, if I use probability proportional to size, you know what's going to happen? I'll get all 4 of the big ones. I just will. Because what you do is you list in any order, again, hopefully a random order, all your customers, right? Maybe alphabetical. By customer number or alphabetical. They're all listed. You add up the total. And instead of selecting so many customers, you select so many dollars. And your idea is you're going to have an interval to select dollars. Okay? So I pick a random starting point. I add up all the customer accounts until I get to my interval. Okay? Well, first to the random starting point. And then I'll have an interval, just like I described earlier, right? I'm going to have an interval. So I go down X dollars, right? I get to that particular one, I take it. I go down X dollars again, I get another one. I'll hit the same account over and over and over. Those 4 big accounts I'm going to hit over and over because my interval is going to be smaller than the 4 accounts, right? Well, what you do is you just keep going until you get to your sample size. So after you pull those out, you just keep going, right? You keep adding up until you get your sample size. But what will happen is if an account is bigger than the interval I have, say my interval is $200,000, and I've got a $1 million account. What's the odds of not hitting that account? You have to hit that account. Why? I'm going every 200,000. I'm going to hit that account 4 times, minimum, right? Got the idea? Okay? So what this does, probability proportional to size, is to make sure it gets all the big ones. Where would I want to use that? Where I'm looking for completeness or existence? What's the odds of getting an account that's listed at 0 and should be at 100,000? An account with 0 with probability proportional to size, 0 has no chance of being selected. It's not an amount. But if I do accounts instead, so here I'm doing payables, right? I'm worried about payables being complete, not existing, right? So what would I do? I'd probably select accounts instead of selecting dollars. This one selects accounts. This one selects accounts. I'd use this one if I could. If I computerize, I always use this one, right? But if I want to make sure I get the big ones, it'd be this. So again, if I'm doing payables, Probably here. If I'm doing receivables, probably here. Got the idea? Because what do I worry about on receivables? Completeness or existence? Do I want to get the ones that are zero? Well, I don't mind, right? But I'm not going to promise somebody owes me nothing. I'm testing for existence. Does it exist? Got the idea? Okay.
So you still use a random sample for number 3.
Yes, it's still random.
Until you get a dollar.
Yeah, all 3 of these we hope are random. Then we'll just use intervals here, right? Intervals on both of these, right? Here are intervals of documents or intervals of records, right? Here are intervals based on the dollar size, okay? So it's probability proportional to size, also called dollar unit sampling. Dollar unit, why? Because my sampling unit's $1, right? Got it? So we'll do more of that when we get into the substantive chapter. Good. All right, anyway, we talked about those. Bias, got to be careful about the bias on each of those. All right. And so what are the advantages that we use of computer-generated random numbers? Time savings, don't have to make them up. Reduced risk of error, automatic documentation. Tell you what, if I went to court, I sure would prefer to say that I followed statistical sample than judgment. They can rip you to shreds with judgment. Why didn't you look at that? In my judgment, I didn't need to. No. Why didn't you look at that? A random number generator did not select that. All of them had equal probability and selected. I didn't have to hit the one where the fraud was. We're not doing a fraud audit. Versus if I use my judgment, well, I just decided not to look at that. Oh, really? Why didn't you look at it? If you had, would you have found the fraud? Yes. Either way, they're going to say that, right? But at least you had statistics on your side versus, oh, I just decided, right? All right.
For the probability proportional size, it says that it's evaluated not, or using a non-probabilistic sample, or a non-statistical method.
Yeah, well, it violates classical statistics.
Is that just because you're picking $1?
Yeah, you're picking $1. But it's still, it has statistical validity. We can still say that we have a 5% risk or a 10% risk of incorrect acceptance, right, on population. Does that make sense? Yeah. So, but it violates statistics the way I would put it, classical statistics. But it's still okay. Okay, so here they talk about the systematic sample selection, the interval, right, population size by the number of samples desired. Okay, probabilistic. A sample is taken where the probability of selecting any individual population item is proportional to its recorded amount. Each dollar has the same probability of being selected. So the accounts that are big have far more probability to be selected than the ones that are smaller. So you divide the population into subpopulations, take larger samples from subpopulations of larger sizes. Yeah. Okay. Good. All right. What are these things? Now, guys, attribute sampling is testing controls or testing transactions, right? The attributes of it. And usually it's a yes or no answer. Did they follow the internal control or not? Is the transaction recorded properly or not, right? It's not, is the balance correct? Okay? Right? That's going to be chapter 17, okay? So, substantive testing. So, an attribute is a characteristic. It's a yes or no answer. You know, do they have blue eyes or not, right? It's an attribute. Did they follow the internal control or not? Everybody got it? An occurrence or exception rate is the percent of items in the population containing the characteristic or specified attribute. Okay, so what do we mean containing the characteristic or specific attribute of interest? What does that mean? An occurrence rate is how many times the attribute will be there. What's an exception? It's not there and you expect it to be. Okay? So you're going to look at your exception rate. Okay. Okay, a deviation from the internal control, right, is an exception or a deviation. Everybody good with that? Not a very big deal, really. Okay, so an exception rate is a deviation rate, okay? Monetary misstatements in population of transaction data, so again, it's a yes or no. Did they record it right or did they record it wrong, okay? And then monetary misstatements in populations of account balance details, what's that? how far off are we in terms of the misstatement, okay? So we're going to have a tolerable misstatement, we're going to have an expected misstatement, a tolerable misstatement, and a sample misstatement, and then the sample misstatement is going to be projected to the population. So we get our own independent estimate of the population error, the error we think is in the population. Do we know how much the error is in the population? Of course not. It's based on our sample. Okay? So then we'll put a confidence interval around that. This is just easy, right? Okay, so, these are really the same in the statistical or not. So the terms used, characteristic or attribute, is the internal control functioning or not, right? Is it there or not? Is the transaction recorded properly or not? And then an acceptable risk of over-reliance. What do we mean here? Over-reliance on what? I relied on the controls more than I should have, and I reduced my synthetic tests, right? I thought they were better than they really were. So I'm going to accept some risk of that. The lower the risk, the larger the sample, right? Okay, and then inverse is true too. Okay, tolerable exception rate. This is how many times they did not follow the internal control and I'm okay. Or how many times the transaction doesn't get recorded right and I'm still okay. There are hundreds of thousands of transactions, I'm looking at a few of them. What if I find one that's not recorded right? Or one time the control's not being used? What do you think? And I'm looking at 25 out of 25,000. Each one of those in my sample represent what? 1,000. So if I find one wrong, what do I think? There are 1,000 wrong. Plus and minus my allowance for sampling risk. Oh man, right? It's huge. So what are you expecting to find? None. You're looking for none. That's what I want. Okay, a tolerable exception rate. Let's say I'm willing to live with 4% of the time. Versus if I'm willing to live with 8% of the time. And what is going to determine that is how important I think the procedure is, right? How important is the internal control to me? How important do I think an internal control is if 8% of the time is okay that they don't follow? Probably not very important. What if it's 4%? It's real important. What if I want it to be 1% and I decide that I'm going to establish my tolerable exception rate at 1%? What happens if I find one exception? I'm blown out of the water and I can't rely on the controls. Got the idea? So what do you want your tolerable exception rate to be? As high a number as you can live with. Got it? And still think their controls are doing the job. What if they have two different controls that try to accomplish the same thing? Might you be able to set both of the tolerable rates higher? Yes. Okay, so it's nice to have duplicate controls. Okay, all right. So tolerable exception rate, estimated population exception rate. This is what I expect to see. What do you want this number to be? Big or little? Little, as small as possible. If I have a 1% expected exception rate and I have a 8% tolerable, life's good. I can take a small sample and I'm still going to be within the range. What if I have an estimated 4% and I have 6 tolerable? Probably the control's weak. Probably don't even test it. Because your sample size is going to be astronomical, right? The further these two get apart, what happens? Get a smaller sample. Closer they get together, bigger sample. Points on the CPA exam, you guys, for knowing that. No kidding, right? You'll love it if you know those relationships. Okay? And then we're going to determine the initial sample size based on what our expectation is and what's acceptable to us. Okay, so these three are interacting. Everybody got the idea? Three are interacting. All right. So what's an exception? They didn't follow the control. Or the transaction didn't get recorded correctly. Right? Okay? The sample exception rate, what you found in your sample. Right? And then we are going to compute an upper exception rate. Now here's the one difference, like you were saying. When we use stat sampling, we will actually have this number. When we use judgmental sampling, we won't have it. And it's a huge disadvantage of judgmental, right? Non-statistical sampling. Huge disadvantage. This is a wonderful number. Because I can say, well, the worst it could be, the percentage of the time they don't follow their controls, the worst it could be is that number. And if that number is below my acceptable, right, rate, I'm good. Control's strong. Got it? So again, What happens if this number is above what you're willing to live with? Oh, well, you're real unhappy, right? I'm not going to rely on those controls. And I'm going to recommend that they fix their controls before I issue a report on internal controls, okay? I don't think they're functioning, at least not well. All right, plan it, state your objectives, decide whether an audit sample, whether audit sampling applies, define attributes and exceptions conditions, what are they, define the population, make sure all of them are in there, and define the sampling unit. So they run through that. So for an example of objectives, take a look over on page 487. There's an audit area, test the controls and substantive test the transactions on the billing function, right? On figure 15.2. Define the objective. What would be your objective? So this is state the objectives of the audit test. Got it? So could you do this in an area? Examine duplicate sales invoices and related documents to determine whether the system has functioned as intended and is described in the audit program, and as described in the audit program. So, what do I want to do? I want to see whether or not they're following their internal control. That's the objectives of the audit test. No kidding, right? Okay. Define the population. Sales invoices for the period January 1st to October 31st. It happens to be first invoice number is such and such, less invoices such and such. Have I defined the entire population? You bet. Okay? All right. Define the sampling unit, organization of population items, and random selection procedures. For instance, sales invoice number. What does that mean? My sampling unit is the sales invoice number. I am going to get a random sample of sales invoices between 3,689 and 9,452. That's simple. You need to be careful to define your population to make sure all of them are included, right, that were used during the accounting period, and none are included that weren't used in the accounting period. And it's as simple as that, you guys. Okay? So make this real. Be able to give a real example, right, if they ask for it. Okay? Or if I ask for it. All right. Define the sampling unit. That's it. Sales invoice number. Okay? Record in the sales journal sequentially. That's nice. The computer put them all in numerical sequence. They're there. Computer generation of random numbers. So I'm going to get a random number to get my selection. Okay? So then I've got them, right? Now here's the attributes. So we're defining the attributes and exception conditions. So look at 1 through 9 there. Existence of a sales invoice number in the sales journal. Oh, there you go. Right? Is it there or not? It's a yes or no attribute. Everybody got it? What's an exception? It's not there. Got it? Okay. Amount and other data in the master file agree with the sales journal, right? Entry. What do you think about that one? What's the attribute? It agrees. What's the exception? It doesn't. Is this easy or what? And you can do it for anything, right? Everybody got it? And all of them are going to be the same as that. Okay? So after you define the sampling unit, what are you going to do? You know the population, you know the sampling unit, you're going to determine your sample size and then figure out how you're going to select your sample. Okay? All right? So specify the tolerable exception rate. What would that be? How often can they not do each of those things? So you come up with an expected error rate or deviation rate. That's the first column under the planned audit, right? We expect 0 or 1 on all of them, don't we? Oh, I guess 1.5 on some, right? Okay, that's how often that's how many we expect to have. That's the percent, okay? What is the tolerable deviation rate or expected tolerable exception or deviation rate? That's that TER, see it there in the column? Notice how much larger those are than the expected. Hopefully you got a spread like that, okay? Then what do? Specify the acceptable risk of over-reliance. What do each of those mean? If it's low, what is it probably? Probably 5%. What if it's moderate? Probably 10. Okay? Right? High, most people don't use it. Okay? All right? and then the computer will calculate your sample size for you. Okay? Got it? Based on what? What's driving that sample size? They're all low on their acceptable risk of over-reliance. What's driving it, you guys? It's the difference between the expected rate and the tolerable rate, right? The bigger the difference between them percentage-wise, what happened to your sample size? It went down. The closer they get, it went up. Everybody see it? That's what's going on. Okay, good. All right, so I suggest that you get really comfortable with page 488 at the bottom, guidelines, what's going to happen, okay? What kind of things that you do? That's a really good one. Your judgment, if you want the lowest assessed control risk, right? You're going to have a low acceptable risk, right, of over-reliance. Moderate would be medium. Higher would be high. What if you want 100% of your control risk? You want 100%. You can't do it, right? You're not going to make it. Okay, there's no sample size big enough. Okay, so yeah, and the same thing with the transactions. Okay, and they gave some rules of thumb there: 4%, 5%, 6%. Okay, all right. So specify the tolerable, specify acceptable risk of over-reliance, estimate the population exception rate, and determine the initial sample size. Okay, select the sample, perform the audit procedures. Okay, and then what we're going to do is what we found in the sample, we are going to look at every single one that's an exception, like why, what went wrong, okay? And then we're going to extend those to the population. So if I find out that 4% of the time they're not following the internal control, I think it's at least 4% of the time in the population they're not following the control. If I find in my sample 4% of the time they're not. Got the idea? Then I think it's at least that much with the population. Could it be more? Yes, because I'm relying on the sample. Okay, so good. All right, there's that we talked about. Okay. Okay, this is non-statistical sampling. Okay, what's the effect? This is nice. And they don't have this in the book, do they? Well, they kind of do. On page 490 at the top, affect the sample size and changing factors. Okay? Yeah, it is the same thing, I guess. Is it a direct or indirect relationship? They'll ask you that a lot. Okay, so if I am willing to increase my acceptable risk of over-reliance, what happens to my sample size? It goes down, right? If I want to reduce my acceptable risk of over-reliance, right? I'd like to have less risk of over-reliance. I'm going to have to take a what? Larger sample. Inverse relationship. If I increase the tolerable risk rate, so we're assuming that the expected is staying constant, the tolerable is going up. What happens? More spread between them, smaller sample. What if I want to decrease the tolerable risk rate? I'm going to decrease what I'm willing to live with. It's getting closer to the expected, right? No matter what the expected is, and that will increase the sample. Everybody got it? These simple? Okay? Just let yourself think about it, get real comfortable with it. Okay? All right? So that's an inverse relationship too. If I increase the estimated population exception rate, so I think the number of times that they have an exception to the control, or the number of times that they don't record the transaction properly, is higher. I'm going to increase that. And I'm leaving the tolerable rate the same. They're getting closer together. What's going to happen? Bigger sample. Got it? This is a direct relationship. Everybody good with these? Real comfortable? Okay, we'll do the same thing with the substantive testing. This gets tested a lot. Okay? Increase in population size, I disagree with Minor. I think it is probably almost none. Minor's understated. What's the deal? I have 100,000 invoices, you guys. What if my population size goes up to 110? What happens to my sample? Nothing. Right? If I have a huge population, what does a change in the population up or down by any amount that's within a relevant range probably going to do to my sample size? Nothing. Got it? But what if I only have 100 customers and I raise it to 200? That's going to affect my sample size when I'm selecting number of customers to confirm. What if I go to 500? It's really going to affect it. But what if I go from 100,000 transactions to 110? It's a big 10,000 spread, right? Probably not going to affect your sample size. Got it? It's because these are huge samples when we're doing tests of attributes, which are tests of controls, right? Controls are attributes. Yes, they're following it, or no, they're not. Attributes test is yes or no, basically, right? Okay? And tests of recording transactions. Thousands and thousands of transactions. Yes, they recorded it right. No, they didn't. Got the idea? Everybody good with this? I'm not telling you anything you didn't already know? You just look at me like I'm an insane person, so wasting your time. Is that right? You always look at me like I'm insane. Because I am. Okay, good. I got it. All right. Okay. Before we do this, let's look at the bottom of page 490. I don't think there's a slide in here on this one, but there might be. The little box at the bottom of 490 is really good, and this is judgmental sampling. This is the audit sampling, the audit guide on audit sampling, okay, from the AICPA. What do you do if these are really, really small populations? You know, quarterly we do something, 4 times a year. What do you do if you do it monthly, 12 times a year? Semi-monthly, 24, weekly, 52. The population is tiny. You know, you're making adjusting journal entries of some kind, right? And recording depreciation. 12 times a year. You guys got it? I'm estimating inventory for my quarterly statements 4 times a year. Got the idea? These are almost never happening, right? Okay? How many items do you test? These are just rule of thumb. How many are you really supposed to look at if there's only 4? Stat sampling would say all 4. How about if it's anything less than 30? Even randomly distributed. Would you ever, if your population is randomly distributed, would you ever look at less than 30? No. Oh. Well, geez, I'm not going to look at all of these. So I do 2 if there's 4, I do 2 to 4 if there's 12, I do 3 to 8 if there's 24, and I do 5 to 9 if there's 52. Did I violate classical statistics? Hell yes. Would I violate every single time in this situation? Of course I would, right? This is judgmental sampling. I'm not going to look at all of them. What for? Okay, got the idea? So that's really a nice one. Okay, what can you do if the population is not acceptable? Be careful. Can you change the tolerable exception or deviation rate? An exception is they didn't follow the control, a deviation is they didn't follow the control. Terms are interchangeable. Okay, can I revise it? Yes, but be careful. What are you saying? I'm willing to let the control be weaker and still rely on it, right? Or my idea that's still being strong is that they violate more often. Or I can revise my acceptable risk of over-reliance, right? But now I'm taking on a riskier on, right? And what would either of those do? It might make me get within the range of acceptability. Be careful, be careful. You want to decide what you're willing to live with before you do your sample and do all your work. You don't want to change after the fact to make it work for you, okay? Expand the sample size. This is dangerous. I take a small sample and I find a few exceptions. If I have a truly random sample, what's going to happen if I double my sample size? I do it again. I looked at 100, right? 100 checks for 2 check signers out of 1 million, right? Okay? And I find too many of them. I think the percentage of the time that they don't follow that control is too high. So I think the control is weak, right? What happens if I double the sample? What's probably going to happen to me? Now I look at another 100. You'll find exactly the same thing and you will have wasted time and money. You need to believe something was wrong with your sample, right? My sample was somehow biased. I got unlucky. Maybe I just got unlucky. And what's the client going to always argue with you? Oh, just look at some more. I'm sure we follow that control. Just look at some more. And what you need to say is, I'm willing to look at more if you want, but I bet it turns out the same, and we're still going to have to increase the substantive testing. Or if you're relying on the controls, you're using the controls to give them an opinion on internal controls, you're still going to have to improve the control before I can give you your clean opinion. Got the idea? Unqualified opinion. We're not supposed to say clean anymore. Unqualified. Okay? And your essays on the CPA exam don't write clean opinion, write unqualified. Okay? Even though I fall back on that to say it, because we used to say that all the time. It's clean, right? Call it unqualified. All right. We could revise the assessed control risk, of course, but that might mean we're not relying on the controls and we're increasing substantive testing. I like that one the best. That's the most logical. Communicate with the audit committee or management, of course. They need to improve the control, right? Okay, all right. So this is the same thing, right? This is with stat sampling, but what happens? What's the only thing that's any different here? We're going to compute an upper exception rate, okay? The number of exceptions in the sample and the actual sample size are used to compute the upper rate, okay? All right, evaluate the results. All right, test and controls is attribute sampling. I said that, substantive test transactions. A frequency distribution of the results of all possible samples to a specified size that can be obtained. The sample from a population is a sampling distribution. Okay, it's based on the binomial distribution. What do we mean? It's a yes or no, right? Yes, they follow the control. No, they didn't. That's attributes. When we're doing variable sampling, we're sampling balanced for balances, right? It'd be mean per unit sampling, probably. A couple of other methods. Get to that chapter. Okay, so here's an example of the probability distribution. They give you this in the books, and it's just useful to know. If there's 0 exceptions, right, percentage of exceptions is nothing. This is on a sample size of 50, right? Right? So the probability, right, is only 0.0769, right? So if I find none, I still think it could be this bad. You got the idea? Because I only looked at 50. So it still could be that bad. If I find 1, it could be this bad. Look how it explodes, right? If I find 4, right, look at this, and so on, okay? So what happens is my cumulative probability here is getting worse and worse, okay? So you're going to get, with only 50, if you find any, you're blown out of the water already, is the point of that, okay? All right. So using these tables, population size is minor, as we indicated earlier. Representativeness is real important. Okay. Take a look on, I thought they were in there. Take a look over at. They don't want you to do stat sampling, you can tell. Let's do it anyway. Over on page 502. Okay? So in case you get some questions on the CPA exam, on my exam, and final, right? In case you get some of these, take a look over on page 502 and 503. Okay, this is really simple. What these tables 15.8, tables 15.8 on page 502, what these do for you is they tell you your what? Sample size. It's really handy. Now, what you're going to do is you will tell the computer when you're at work. Have you guys done this yet? Probably not. The seniors probably did it. Did you do some? Have you do it? Senior did. Yeah. Okay. Where's the judgment here? You have to know what you think the estimated population exception rate is. Might be based on what you found last year. Might be based on your understanding of the internal controls, right? The design of it. What you know about the client. What do you expect, right? So what percent of the time do we think they are not going to follow the control? Or the transaction's not going to get recorded right. Got the idea? That's the estimated population exception rate. What's the tolerable? I still think the controls are good if they don't follow the control that percentage of the time. And I think the transactions are probably recorded okay if they don't record it properly that percent of the time. Got the idea? Okay? So let's say that I think 1% of the time they're not going to follow it, and I'm willing to live with 4% of the time. How big does my sample have to be? What risk of over-reliance? Oh, what's that mean? If I'm willing to take a 5% risk of being wrong when I do my audit work, or I'm willing to take a 10% risk. Those two different tables, you see it? Ah. So what would you expect at 5% versus 10%? And those are usually what we use, one or the other, right? Low and medium, 5, 10. What are you going to expect? Which one's going to give you a smaller sample? 10, right? Take more risk. So let's see if it's true. If you're on the 5% table, what do you got? 4% I said is tolerable, right? 1% is estimated. What do you get, guys? 156. That's my sample size. I'll pull 156. That's extremely expensive. What if I can go to 5% tolerable exception? Goes down to 93. Look at 6%, 78. Getting the idea? If I'm going to do a sample size of only 30, where am I going to have to be? Clear over at 15%. right? You see it? Tolerable rate would have to be 15%. Most CPA firms take too small samples. That's what you're going to find on this. Okay? What if it's 10%? Let's do 10%. At 1% estimated and 4% tolerable. What happens? My sample size goes down from 156 at 5% to what? 96. Got the idea? By the way, why don't they have a 1% column? And why do the columns disappear? You know, that whole section's gone, isn't it? Right? What happens? There's no 1% column, nothing less than 1%. They don't bother to write any numbers. When the tolerable rate gets close to the estimated rate, what happens? The sample size would be so large it's not worth doing. You don't test the controls. Got it? Everybody good? That's all that's going on. Okay, now I pull them, right? When we go over on page 503, I pull my sample. I test my sample. What do I mean? I'm testing whether or not the control is being followed, right? Yes or no? I'm testing whether or not the transaction is getting recorded properly. Yes or no? Okay? It's attributes testing. Okay? The attribute is either there or not. Yes or no? Okay? Binomial, we said. Okay? So what do? That's why we use those tables, the percentages, right? It's binomial. All right? What do? If I pulled my sample based on 5%, I will evaluate it based on 5%. Got it? Risk of over-reliance. If I pulled it based on 10, I'll evaluate based on 10. So let's say I pulled at 5, and I pulled a sample size of, I don't know, 50, okay? So I pulled a sample size of 50. What can I say now? If you pulled a sample size of 50, and you find 0, I'm on table 15.9 at the top of 503, okay? So I pulled a sample of 50, and I found no exceptions. What can I say? What's the upper exception rate? My computed upper exception rate. That's what these are. 5.9. Everybody see it? I think as much as 5.9% of the time they are not following the control. Got it? Because I found 0 in 50. What if my sample size had been 100? What can I say? If I found 0. 3%. See what a bigger sample does for me? You good, guys? Let's go back to 50. What if I found 1? Oh, man, I'm up to 9.2. What if my tolerable exception is less than 9.2? And my computed upper is 9.2. I can't rely on the controls. Got it? I think they're weak. Okay? Might be good by design, but not being followed. What if I did 100, though, and I'm at 4.7? And what if my tolerable is 5? Life is good. Right? Larger samples are more expensive, but they're safer, right?
So it's ARO, the risk that included effective.
Risk of over-reliance. Yes, effective, not defective. Effective? Yeah. You think the internal control is being followed, that the control is effective, when it is indeed not. That's risk of over-reliance.
There's a 5% chance.
5% chance. So 95% of the time you're right, 5% of the time you're wrong. Get used to it, you guys. You're going to be auditors. You are going to be wrong sometimes. You mean if it's 5% risk of over-reliance, I'm only right 95% of the time, 5% I could be wrong? Yes. 1 out of 20. What if it's only a 10%? You're willing to take 10% risk of over-reliance. You're only right 9 times out of 10. 1 out of 10, you're wrong. We get some risk in our business, you guys, and we get sued, right? But what happens if we want to get that risk way down? So let's take it down to 1%. What are you going to do with sample size in the back? Audits are too expensive. You can't do it.
So when your confidence interval will be 1 minus your ARO.
Yes. You got it. 1 minus the risk of over-reliance would be, right, how confident you are. Okay, good. Everybody, you see how to read these then? So if I asked you to do that, could you do it for me? Okay, not a big deal. One more thing, and I'll let you out of here. Hey, we're on time, aren't we? Now, this is amazing. I must have skipped everything. Okay, anyway. I think I covered pretty much everything in here. You guys pound through this, read it. This would be a good chapter to read again. And the same with 17. Why didn't I have a student do this one? How many of you wanted to come up here and do this job? Oh, shit. The other ones are kind of easy in comparison, huh? Right? Yeah, I know. All of you would have done a better job than I did. I could tell you were thinking. Okay, all right, anyway. On page 504. There's the same plan, right, guys? See the same plan there? And they did the same thing earlier for the judgmental, the non-statistical. It's the same thing, except you don't have a computed upper confidence, or a computed upper error rate, right? Which is really sad. It sucks. You want that number, okay? And you guys, did you use, any of you guys just went out there and worked a little bit, which is a bunch of you guys. Did you ever use non-statistical sampling? Or did they always have you use random numbers and, I mean, they stratified judgmental rate, right?
I've done haphazard.
You did haphazard before?
Not very often.
Oh, God. I hope they're little tiny clients, maybe. Yeah. That's still awful.
That's sad.
You did some of that? You did some block? No?
We were big on the proportional size.
Yeah, probability proportional size is excellent. I love it.
But they just started. I'm pretty sure that was kind of new for.
Who are you with?
Instant.
Oh, okay. Yeah, I might be new for them. Who were you guys with?
I was with EY.
EY, stat sampling?
Yeah, they had just got, I guess it was like their peer review, they kept, I guess they got told they weren't testing enough, so.
Too
we would
small
pull
samples?
some, and then they'd go, just pull a little extra.
Oh, jeez. No. Change the program. They got their program set up by a non-statistician probably.
Yeah.
You know, and so their sample size. You can look at these, you guys. These sample sizes, this is done right, okay? These are big compared to the ones you were doing probably, aren't they? Some of them are pretty big. Yeah, that's what you should be doing. We really should. Okay. But it's expensive, right? So what's really happening is they're taking more risk. You should compute how much risk they're taking then. It's probably 25% instead of 10. And they think they're doing 5, right? Oh, no, you're not, right? Statistics are statistics. Who else did you guys work for? PwC? You guys are using staff probably, huh? Cool. Smaller firms tend to use more judgmental, but then they have smaller clients too, and they know the clients better, right? They know the numbers better. They know the transactions better. And a big client, you know, it's kind of this black box you're auditing, isn't it? And there are millions of transactions out there trying to pull out pieces of it. So that's kind of cool. That's a good insight to get too. But what do we have here? Look at the columns. Look at the expected rate versus the tolerable exception, the first two columns. Notice they were quite a ways apart. We looked at that already, right? But their acceptable risk of over-reliance is low, isn't it? So what did that do to their sample sizes? That drove them up. But to the extent that the expected is smaller than the tolerable, what does that do to your sample size? If that spread is big, what happens? Sample size is smaller, right? You have to be less refined in what you look at. You can look at fewer of them and feel comfortable. Got the idea? Okay? But then what happens if the acceptable risk of over-reliance goes down? That sample size bumps up. So that's driving all the sample sizes up. If you change that to 10%, you could go look it up, you guys, right, on the tables we were just at. Those sample sizes go way down if you go to 10%. Okay? So a firm can decide what they want in terms of their risk level. Some are more risk-prone or risk-averse than others. Some will accept more risk. Yeah.
So is there a difference between ARO and sampling risk? Or is ARO and that's your sampling?
No, sampling risk is the risk that your sample would not be representative of the population.
And then ARO.
Acceptable risk of over-reliance is you're taking a certain risk that even if you get a good sample, right, you take a representative sample, you still get the wrong decision. Not because of non-sampling risk, just because samples won't necessarily give you a representative sample, even though you use random number generation. Does that make sense? Okay, sampling risk is a risk of getting a bad sample. Okay? Allowable risk of over-reliance is it's a bad number and I rely on it, or it's a bad control and I rely on it. Okay? Different animal. Okay? That's a really good question. Okay, anyway, so what we did, they calculated their sample size, they took their initial sample, and then they find their number of exceptions. You see that? And you can see if there's a whole bunch of exceptions, what happens to you. The number of exceptions, the sample exception rate, they get just converted into a percentage, right? And look at that. Look at the calculated upper exception rate. Is obviously huge when you get a lot of exceptions, right? Now what are you going to do? Compare the computed upper exception rate to the tolerable exception rate. On the ones where the tolerable is less than the computed, what do you have? That's number 2, for instance. Well, first, let's do them all. Number 1 is 4 and 4. What do you think? Okay, I love it. I made it, right? It could be as bad as 4, and I'm willing to live with 4% of the time. The next one, number 2, 5 and 6.2. What do you think? Nope, I'm done. Out of the water, right? Doesn't matter how much it's over. It's over. Okay? All right? Double meaning there. What about 5 and 3 on the third one? I'm happy. I could live with 5% of the time. And by the way, it's upper, you guys. It's the maximum you think you could be off at a 5% risk level. Got it? The maximum you think you could be off, okay, is 3. And you compare to 5 you're willing to live with. You're good. How about 16.4 compared to 5? Ugly, right? That's a weak control. That one's got to be fixed, okay? The next one, 9 compared to 5. Weak control, okay? On number 5. Number 6, 6.6 compared to 7. I'm a happy camper. It's less. The maximum it could be is less, okay? That's it. Okay, 5.9 is less than 9, I'm good. 31.6 is a bit more than 9, miserable control. Got it? That one's got to be fixed, okay? And then number 9 is fine, 7 compared to 4.6. So what I've got is number 2, number 4, number 5, and number 8. What do I have to do? If I'm determining some standard tests, don't rely on those controls, right? Now that would be a private company audit, right? What about a public company audit? Now I cannot give an opinion on internal controls related to that, right? Okay? What do they have to do before I can give an opinion? Fix the control and have it operate. So is it important in a public company to test controls early in the year? Yes. What if you find out they're not operating well? Get it fixed. So you can do what? Go back and test them and find out they're working now. Boom. Do you have to have the controls working effectively all year long to give a clean opinion, unqualified opinion, on internal control? No, they just have to be operating at the end of the year. What if they're operating at the end of the year, but they weren't operating all year? You can give the opinion on internal controls, but what about the opinion on the financial statements? Oh man, it's an expensive audit, because what do you have to do? A whole bunch of substantial work on the ending balances, because you can't rely on the internal controls, because they weren't in effect all year. But you can still give an unqualified opinion on the controls, can't you? And then just spend a whole bunch of money to get the audit done on the financials. Make sense? The financials are historical. We said this really early on. It kind of makes more sense when we get to this point. The financials are historical. The controls are future prediction, right? Can people rely on them to make sure the statements they're looking at quarterly and so on, monthly, quarterly are good? Okay? Everybody good? One thing I would do is I'd go through all those essential terms and make sure you really got it down, right? I know what all those things are if I see them, right? What are those things in this particular chapter? Wasn't that fun? Are we supposed to be done now? Yeah. Why are you guys staying here? 6 minutes late. We don't have a clock. Thanks for coming today, you guys. Those of you who listen to this at home, I'm really glad you took the time to listen to it. Those of you who don't, oh well, you're an ugly Jeff. They didn't get that message.